Think of a balance sheet as an X-ray for a business. It shows exactly what a company owns, owes, and its net worth. Stick with me. I will show you a simple example that makes it click instantly. Think of a balance sheet like an X-ray of a business. It shows the complete financial picture. By the end, you will know how to read and even create one. Stick around. We will also cover a common beginner mistake. It's more than an accounting sheet. A balance sheet helps you plan loans, expansions, and shows investors your company's health. Misreading it can lead to poor decisions. This simple equation is the backbone of accounting. Assets are owned, liabilities are owed, and equity is the owner's stake. We will apply this in real examples soon. Assets are resources the business controls. There are two types of assets, current assets and non current assets. Current assets are short term, and non current assets are long term. Current assets are cash, inventory, receivables. Non current assets are equipment, buildings, and patents. They link directly to liabilities in the balance sheet. Liabilities are what the business owes. Equity is what remains for the owners after paying debts. There are two types of liabilities as well, current and long term. Current means short term liabilities, long term liabilities like loans and bonds. Understanding both liabilities and equity is key to seeing the business's real worth. Here is an example of a balance sheet, which is basic accounting statement. On the left is our assets, what the business owns, cash 5,000, in oven 20,000, in ingredients 2,000, totaling $27,000. In the middle are liabilities, what the business owes, a bank loan of $15,000 and payables of $3,000, totaling $18,000. On the right is equity, the owner's share, which is $9,000. The key idea is the accounting equation is equals assets equals to liabilities plus equity. Shown at the bottom is $27,000 equals $18,000 plus $9,000. This means everything the business owns is financed either by borrowing money or by the owner's investment. Even professionals make mistakes. Always separate personal finances and classify items correctly to avoid confusion and errors. Balance sheets are practical tools. Track them regularly, compare with prior months, and use templates to avoid mistakes. Quick recap. Assets are owned, liabilities are owed, and equity is residual value. The balance sheet is a financial snapshot. Always start with this to understand any business. Thank you very much.